All right, let's dive into the latest earnings from Foundry Bancorp, ticker BLFY. This quarter's results were a real head-scratcher, a classic Wall Street puzzle. We've got a big disconnect between the progress the company's making and how the market is reacting, and that's exactly what we're going to unpack.
So here's the big question, right? The bank actually beat on revenue. So why on earth did the stock fall? I mean, on the surface, everything looks pretty solid. They beat expectations, key metrics are looking better, but the stock still ended the day in the red. So what gives? What did investors see that the headlines missed?
Okay, so first things first, let's get the headline numbers on the table. This is really what sets the stage for the whole story. A company that's hitting some of its goals, but, still can't quite shake that investor skepticism.
So here are the core numbers. The loss per share came in at 10 cents, which was, well, exactly what everyone expected. No surprises there. But the revenue, that was a nice beat, coming in at $12.61 million. And their net interest margin, which is super important for a bank's profitability, actually ticked up by 6 basis points. But despite all that, the stock still went down. It wasn't a total disaster, sure, but it definitely tells you the market was not impressed.
And let's not just gloss over that revenue number, a 33% increase year over year. That is a huge jump, and you can bet management was talking about this. It really shows that the core engine of the business is starting to generate some serious power. All right, so with that strong revenue growth as their headline, management basically stepped up to the plate to tell their side of the story. And the story they're telling is all about a strategic turnaround that's building momentum, even if the actual profits, well, they haven't quite shown up yet. And this quote from the CEO, Jim Nessie, really nails their message. He said, "The progress against these strategic initiatives better positions us for continued growth and long-term value creation." So what's he really saying? He's asking investors to be patient. He's saying, hey, look past the losses today and focus on the solid foundation we're building for profits down the road.
And here's the plan in a nutshell. They're telling us they are executing across the board. Core deposits, up. The loan portfolio, growing. That all-important net interest margin, expanding. Plus, they grew their tangible book value to over $15 a share while they were buying back their own stock at around $9. That's a pretty smart move. It shows they think their stock is cheap, and it's an immediate win for the shareholders who stick around.
But, and this is a big but, as we've already seen, the market was just not buying it. The response was lukewarm at best. And really, it paints the picture of investors who are just getting tired of waiting for this whole turnaround thing to actually show up in the bottom line.
And I love this slide because it shows the disconnect so clearly. On one side, you have management saying, hey, profitability is slowly getting better. Look at all these great operational numbers. But on the other side, you have the market's verdict, selling the stock on pretty high volume. The message from Wall Street is crystal clear. Show us the money. They want to see a clear, fast path to real, sustainable profits. Slowly just isn't cutting it. And here's why that patience is wearing so thin. Just look at the past year. Foundry is down almost 25%. Meanwhile, other regional banks are up over 5%, and the S&P 500 up over 17%. I mean, when you're underperforming by that much, you've got to deliver more than just slow improvement. You need to make a splash to get investors interested again.
Okay, now for my favorite part of any earnings call, the Q&A. This is where you can really read between the lines, because it's where the analysts get to poke holes in management's carefully crafted story. It's the ultimate stress test.
And the first big question on everyone's mind was about that net interest margin, the engine of the whole bank. Was that little bit of improvement we saw a real trend, or was it just a one-time blip?
And here's the answer. And honestly, this is a huge reason why the market's reaction was so blah. Management said the next quarter's margin is going to be relatively flat. So, no big improvement coming right away. The kicker is that the real benefit, the big tailwind, doesn't show up until 2026. They've got a bunch of old, low-rate loans that will finally reprice at higher rates next year. That's the big catalyst everyone's waiting for, but, well, it's a ways off. All right, next question. If the bank is growing its loans, what kind of loans are they making? Because as we all know, quality is just as important as quantity, especially in this environment.
And honestly, their strategy here makes a lot of sense. They're backing away from multifamily lending, which can be pretty competitive, and focusing more on commercial real estate and business loans. And the goal here is smart. They don't just want to give a loan. They want to capture the whole banking relationship, including the company's deposits. And it looks like it's working. Their pipeline is over $41 million, with rates above 7%, which is pretty healthy.
Okay, so let's put all the pieces together.
We've got the numbers, we've got management's story, and we've dug into the Q&A. So what's our take? What are we looking for in the next call?
We're calling this one Market Perform. Look, the turnaround story is believable. The operational improvements are definitely real. The problem is, the big catalyst, that major margin expansion, is a 2026 story. So in the short term, it's hard to see why the stock would suddenly start crushing its peers. The risk and the reward just feel pretty balanced right here.
Now, what would it take for us to get more bullish and upgrade this thing? Well, we have a 3-point checklist. Number 1, and this is non-negotiable, deliver a positive profit number. And not just for one quarter, prove it sustainable. Number 2, when 2026 rolls around, we need to see that loan repricing actually deliver a big boost to the net interest margin. And number 3, keep growing those core deposits. If they can tick these 3 boxes, the stock is going to get a whole new look from investors.
All right, before we wrap up, let's talk about a more advanced idea, a potential paired trade for anyone who finds this specific situation really interesting. Now, for those of you who might not know, a paired trade is basically a strategy where you try to profit from one stock doing better than another, which helps you hedge against the overall market going haywire.
So here's our slightly out there but totally plausible idea for a trade. It's a classic pair. You go long Blue Foundry, BLFY, and at the same time you short the regional banking ETF, which has the ticker KRE.
So let me break down the thinking here. Going long BLFY is your bet on this specific company's turnaround story in 2026. And the fact that the stock is trading way below its tangible book value of about $15 a share, well, that gives you a nice margin of safety. Then you short KRE as a hedge. This protects you if the entire regional banking sector gets hit by, say, worries about interest rates or commercial real estate. The whole point of the trade is for BLFY to simply outperform the rest of the sector as its own story gets better. You're betting on the difference between the two, so you can potentially make money whether the sector as a whole goes up, down, or sideways.
And of course, we have to say it, remember, this is all for informational purposes. This is not financial advice.